The energy sector is undergoing a revolution. For over a century, the world relied on fossil fuels, coal, oil, and natural gas to power economies, transport, and industries. Today, however, a new force is reshaping energy markets: renewable energy. Among these, solar power has emerged as both a technological marvel and a financial opportunity. Investors, policymakers, and energy companies are asking a critical question: is solar the most profitable bet for the future? The answer is far from simple. While solar energy promises sustainability and long-term growth, profitability depends on technological innovation, government policy, market dynamics, and strategic financial planning. Today, we dive deep into the evolving world of energy finance, exploring why solar might dominate, the risks involved, and what it takes to make money in the energy markets of tomorrow. The rise of renewable energy investment. Global energy demand is skyrocketing. Industrial growth, population expansion, and electrification have created enormous energy needs. Historically, this demand fueled oil and gas investment. But rising environmental awareness, climate change concerns, and international agreements have shifted focus toward renewable energy. Solar energy has become a centerpiece of this shift. Photovoltaic technology has advanced rapidly, reducing costs and increasing efficiency. Investors see opportunities in solar farms, rooftop installations, and utility-scale projects. The scale of investment is unprecedented. Governments provide subsidies, tax incentives, and regulatory support to accelerate adoption. Private capital, venture funds, and multinational corporations are pouring billions into solar infrastructure. For finance, the solar sector offers the chance to invest in a growing market with predictable cash flows and long-term contracts. Understanding solar's profit potential. Solar projects generate revenue through electricity sales. Unlike traditional energy, solar plants have low operating costs once built. Sunlight is free, maintenance is minimal, and technology lifespan ranges from 25 to 35 years. This creates a unique financial profile: high upfront capital costs. Building solar farms requires significant initial investment. Predictable revenue streams, power purchase agreements lock in prices for years. Low ongoing expenses. Operating costs are relatively low compared to fossil fuel plants. From a financial perspective, solar is attractive because returns are predictable and scalable. Investors can structure deals with debt, equity, or blended finance, maximizing profitability while minimizing risk. However, the high initial capital investment means that careful planning and financing are critical. The profitability of solar depends not just on sunlight, but on interest rates, construction costs, regulatory stability, and market demand. Government policy, a key driver of solar investment. No discussion of solar finance is complete without government involvement. Policies can make or break the profitability of projects. Subsidies, tax credits, and feed-in tariffs incentivize investment. For instance, many countries offer accelerated depreciation or direct rebates for solar installations, reducing payback periods. Energy policies can also create demand by mandating renewable quotas or setting carbon reduction targets. However, policy risk exists. Changes in government leadership, budget priorities, or regulations can affect returns. Investors must account for potential shifts in policy when evaluating solar projects. A profitable bet in one country may be far riskier in another with unstable energy policy. Solar's future profitability depends not just on technology or sunlight. It depends on stable, predictable, and supportive regulatory frameworks. Technological innovation, driving costs down. One reason solar is increasingly profitable is technology. Over the past decade, the cost of photovoltaic cells has dropped dramatically. Efficiency improvements allow panels to convert more sunlight into energy. Energy storage solutions, such as batteries, mitigate intermittency issues, making solar more reliable and marketable. Innovations in manufacturing, materials, and installation methods have further reduced costs. Floating solar farms, building integrated photovoltaics, and modular systems expand deployment possibilities. From a financial standpoint, Technological advancements mean higher returns on investment. Lower costs reduce payback periods, increase profit margins, and attract more capital. Companies and investors who adopt cutting-edge technology first can gain a competitive advantage. Solar versus other energy sources. Investors comparing energy options often consider solar against fossil fuels, wind, hydro, and nuclear power. Each has advantages and risks. Fossil fuels, established infrastructure, high energy density, but subject to price volatility and carbon regulation. Wind energy, low operating costs, but site-specific and variable. Hydroelectric, long lifespan, stable revenue, but limited suitable locations and environmental concerns. Nuclear, high output, reliable, but extremely high capital costs, regulatory hurdles, and waste management challenges. Solar stands out for scalability, predictability, and declining costs. It is highly modular. Projects can start small and expand. Unlike fossil fuels, it is carbon-free, reducing exposure to environmental regulations and carbon pricing. While no energy source is risk-free, solar offers an increasingly favorable risk-reward profile. Investors are betting that the global shift to renewables will continue, making solar a long-term growth opportunity. Financing solar, tools and strategies. Financing solar projects requires creativity and careful planning. Multiple models exist. Debt financing. Banks provide loans to fund construction, often secured against projected electricity revenue. Equity financing. Investors take ownership stakes in solar farms, sharing profits over time. Power purchase agreements. Contracts lock in prices with utilities or companies, guaranteeing revenue. Green bonds and sustainability-linked loans. Investors and banks target projects with environmental benefits, often with favorable rates. Combining these instruments allows companies to reduce risk while maximizing returns. Structured finance, blended capital, and partnerships with institutional investors have made solar one of the fastest-growing investment sectors in the world. Financial engineering is as important as technology in determining the profitability of solar projects. A well-structured financing plan can turn a promising solar farm into a highly lucrative investment. Risk management, weather, market, and policy. Despite its potential, solar is not without risk. Investors must manage several uncertainties. Weather variability. Solar output depends on sunlight. Cloudy or rainy regions can reduce revenue. Market fluctuations. Electricity prices, demand shifts, and competition affect profitability. Policy changes, subsidy reductions, regulatory changes, or trade restrictions can impact returns. Technological obsolescence. Newer, more efficient panels can reduce the value of older installations. Effective risk management involves diversification, insurance, hedging contracts, and careful site selection. Investors who understand and mitigate these risks are more likely to achieve consistent returns. Global adoption trends. Solar energy adoption is not uniform. Some regions are leaders due to favorable climate, strong policy, and access to capital. For example, Asia, China, and India dominate solar production and installation, supported by government incentives and large-scale projects. Europe, countries like Germany and Spain pioneered solar adoption, benefiting from feed-in tariffs and strong renewable mandates. North America, the U.S. market is growing rapidly, with private investment and corporate renewable commitments driving demand. Emerging markets also present opportunities. Africa, Latin America, and parts of Southeast Asia have abundant sunlight, growing energy needs, and increasing interest in renewables. These regions may represent the next wave of solar profitability, albeit with unique political and financial risks. The corporate role. Solar as a strategic asset. Large corporations are increasingly investing in solar, not just for energy, but for financial strategy. Corporate investment creates additional demand, strengthens project economics, and reduces reliance on government incentives. Companies with solar infrastructure gain operational stability, lower carbon footprints, and enhance long-term profitability. The long-term outlook. Solar as the core energy bet. The world is moving toward decarbonization, electrification, and sustainable growth. Solar is positioned to be central in this energy transition. As technology improves, costs continue to fall, and regulatory support grows, solar is increasingly competitive with conventional energy. Investors and energy companies see solar as both a financial opportunity and a strategic necessity. Those who fail to participate risk missing the shift, while those who invest wisely can enjoy long-term, stable returns. The profitability of solar is reinforced by global trends, offering a rare combination of environmental benefit and financial gain. Solar and the future of energy finance. Solar energy represents a profound opportunity for investors, corporations, and economies. Its low operating costs, predictable revenue, and alignment with global sustainability trends make it one of the most attractive energy investments today. However, profitability depends on careful planning, sustainability, and global impact. For investors willing to take a calculated, informed approach, solar may indeed be the most profitable bet in the decades to come. The sun is rising not just in the sky, but in boardrooms, investment portfolios, and the global economy. Those who recognize and act on this opportunity could be the next generation of energy pioneers, shaping both the planet and the financial world.